Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the S&P 500 that has obviously been a very poor performer over the past few weeks, just going against all of our expectations, breaking through most of the support levels in this final relentless move down here. And that comes right as the number of news articles mentioning bear market is spiking to the highest level since March 2020. I believe we closed just shy the other day off an official bear market. We dipped down into 20% territory, which is supposedly official bear market territory. So we're going to talk about that in this video. So we're going to try and put all of this into context in this video, hopefully giving you guys as much context into what's going on in this crazy market as possible. We're going to talk about market valuations here. We're going to talk about the potential for the S&P 500 to be going into an earnings bear market like in 2000 and in 2008. What's the probability of that? What's the data saying? If you are interested in following these crazy markets with us, make sure to smash that subscribe button. If you enjoy this video, don't forget to click on that like button. And now without further ado, let's get right into it. Now, the first thing that I want to talk about in this video is the fact that this is a very specific kind of correction that we're seeing on the S&P 500. This move since November till the present day has been a pure contraction in valuations. If you look at where valuations were in late 2021, I believe, November 2021, right here, you can see valuations were around 21, just above 21. You can see since that day, we've had a massive contraction in these S&P 500 forward PE ratios, right? This is what we call valuations. It's the price of the S&P 500 divided by the earnings of the companies in the S&P 500. That gives you a measure of how expensive the market is right now. And so we've come down to 16. So what does this mean? This means that the valuations have been going down, but earnings have still been relatively strong, meaning the actual revenues of the companies inside the S&P 500 have held up pretty well over the past few months. And we've discussed this a few times, but this has been in large part driven by the short-term yield, the 2-year yield, for example, that's been rising ever since November. It's been rising aggressively, and that's been driven by inflation. It's been driven by the Federal Reserve. That's obviously been very hawkish. So I think that's a very important aspect to talk about, that this correction that we're seeing here looks absolutely nothing from a macro standpoint to what we saw in 2000 and to what we saw in 2008. If you take a look at S&P 500 earnings in 2007, they were declining right here. And same thing goes for 2000 here. They were declining. They were in negative. This is S&P 500 operating earnings, the growth rate. So yearly percentage change. Here they were in negative territory. You can see here the fourth quarter of 2021, they were very much in the positive. Will they decline further? Very likely, right? That's very likely they'll decline further, something similar to what we saw here. Will they go into negative territory? That's another question. It's possible. Will it happen imminently? Will it happen now? These are big questions. I think for now it is still too soon to say if we are indeed in a very similar scenario to what we had in 2007 and 2008, which a lot of people seem to be pointing at right now. I think it's very much premature. Evidently, this correction, or what you could call this bear market that we're in, has been a valuations bear market and nothing else. So the way I'm seeing this right now, and keep in mind that I can be wrong and that absolutely nothing is 100% in the market, but what I see is that a lot of that bad news regarding valuations, regarding the short-term yields that are rising, inflation that's getting hot, the Fed that's getting very hawkish, all of those things, everyone has been aware of them. Everyone has priced it in and adjusted their portfolios based on those factors occurring. And the market is always looking forward, not backward. It always wants to look at what's going to happen in the future. Well, we're beginning to see the break-even inflation rate roll over. This still needs to materialize, but it does seem to be rolling over here, perhaps suggesting that we're not seeing inflation continuing to accelerate here. And the 2-year yield, which the Fed basically tracks very, very closely. If you want to know what the Fed is going to do and how hawkish they're going to get or how dovish they're going to get, you'd look at the 2-year yield and that's going to tell you what they're going to do. Right back in September, October, you could very much guess already that the Fed was going to have to start to get hawkish sooner or later, and they did just a month later in November. And you can see what's happening with the 2-year yield right now. It does seem to be retracing a little bit here, maybe losing a little bit of momentum. And these things can happen very quickly. You can see the 2-year goes from trending up violently to reversing in a very short amount of time. Now, if we do continue to see the 2-year yield just climb up to 4.5, 5%, that scenario, that would be very worrying for equity valuations. If we see another spike in the 2-year yield, the Fed is going to have to get even more hawkish. And you could see these PE ratios go even lower. You could see them retest the lows that we saw in 2011 and 2008. But if we do start to get a little bit of good news here, and we assume that the worst is behind us in terms of inflation and in terms of the Federal Reserve getting hawkish, well, then I would say that the S&P 500 is getting close to a bottom here. Well, I would say that the S&P 500 is getting close to a very significant bottom here. And then how high we go after that depends on that earnings side of the equation. If earnings begin to collapse straight away, we'll be heading into a bear market as many people are expecting. If earnings stay stable and we get these types of bars and we get positive bars in 2022, perhaps like we did throughout this period, well, then the market can rally pretty hard. And a big example of that, I would say, is 2019. Look at this. Earnings were pretty much flat throughout this entire period. They were at zero between the end of 2018 and throughout 2019. And what happened to the market between the end of 2018 and the end of 2019? Well, the market went on a huge run. And that's because valuations were going up, because the 2-year yield was going down and the Fed stopped. So, of course, a few caveats. The timing of all this. The timing is a very, very tricky part of the equation. Obviously, we've been talking about this for quite some time, and the market has been steadily moving down. So knowing exactly when the market's going to bottom and begin to price in, knowing exactly when we've seen that peak fear of the Fed and that peak concern of the short-term rates rising, that's a very tricky part of the equation. One of the things that we're looking at right now in terms of the short-term developments we're seeing on the market is the advance decline line. Now, this is the number of issues that are advancing minus the number of issues that are declining. And you can see what we're seeing here is that we're getting divergence for the first time since, I believe, years. We haven't seen this type of bullish divergence. And so what that means is the S&P 500 is going down, but the advanced decline line is going up. The only moment I could spot here on this chart in recent history where we saw this type of development was in these places right here in 2018 and 2017. You can see here the S&P 500 going down and advanced decline line going up, right? That's bullish divergence. And right here again, S&P 500 going down, advanced decline line going up. Now, again, do not come to these videos thinking that you're going to get a crystal ball analysis. We give you the data that we're looking at, we give you the indicators, the research that we're making, and what our thought process is right now in this market. We love to have feedback from you guys as long as it is objective criticism presented in a civilized manner. So if I had to make a summary of this video, I would say that there is a difference between a valuation correction and an earnings correction, and that 2000 and 2008 were earnings corrections. Now that doesn't mean we're not going to get one, right? But we're not currently we're seeing deceleration of earnings, but we haven't seen a contraction in earnings that would pull the S&P 500 down. So we need to be on the lookout for earnings to decelerate and potentially dip into negative territory. We're going to be posting a lot of articles on gameoftrades.net regarding where we think earnings are going to go. We have a lot of very exciting articles that we're going to be posting on how soon we think we could get this type of earnings bear market on the S&P 500, whether that's something that we should consider now over the next couple of months. And then the second part of the equation is this valuation part. And that's a completely different thing. Here we have to look at everything that's been driving down these valuations. Are those factors going to stay intact over the next few weeks, over the next few months? If so, then we could continue seeing this trend down. Or are they going to reverse? And we're going to see inflation perhaps cool down a little bit, short-term rates perhaps stabilize or even begin to reverse, and the Fed not necessarily becoming dovish, but perhaps stepping back a little bit from their very hawkish tone that they would have. Even if they step back from their hawkish tone, that would have a positive effect on the stock market. So I hope that makes sense. And we're also going to be focusing, and that valuation part of the equation is also something we're going to put a lot of focus on our future articles at gameoftrades.net. We have a lot of very exciting content coming up on these subjects that I think will really tell us where the market's going in an objective way, and not just throw out random numbers like 20% yes, we're in a bear market, that's it, we should look for downside. It can be very, very tough navigating the market, especially in periods of volatility. We get emotional, we get irrational, and we make bad decisions. Believe me, I know what that feels like. I've been through that. And that's the entire goal of gameoftrades.net. We try and keep you focused on the data, on what the indicators are saying, what the sentiment is like out there, and what the opportunities are right now. It's very easy to lose money by capitulating when times are hard and going all in when things seem to be very positive and optimistic. I think that's where the value of Game of Trades is, bringing you that research along with an educational aspect on all of this and putting all these complex subjects into understandable, actionable content. Now that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, make sure to smash that like button as hard as you can. Now, in the meantime, I wish you good luck on your trading and see you next time.